Hey everybody, welcome back to Australian Financial Literacy, where we discuss money tips, tax, and navigating financial decisions, starting with the basics and working our way up to smarter, informed choices. Today we're going to be talking about PAYG, or Pay-As-You-Go tax. So let's say you've just started your first job working in a cafe and it's payday. So you check your bank account and you unexpectedly see that the number you thought you were getting paid is less than what you assumed. So you open your payslip and see a number of deductions. To understand why, we need to look at your salary, payslip, and the deductions applied by your employer to determine why you arrived at your paid amount in your bank account. If this is the type of content you're looking to learn about, don't forget to like and subscribe, and let's get stuck into the video. So, to begin, if you're thinking, hang on, I don't get a payslip, then you should probably ask for one. They are mandatory in Australia and should be given to you within one working day of your payday. Now let's have a look at this basic payslip example. We can see the total hours worked, including some overtime hours, and we can see a PAYG deduction of $217. Whilst the gross or total pay for the hours worked was $1,100, due to the PAYG deduction, the net payment to the employee's bank account will be $833. PAYG is an acronym for Pay-As-You-Go-Tax, a system of withholding income tax from an employee or contractor's salary or wage. The payer of the income, i.e., your boss, rather than the recipient of the income, pays the tax directly to the Australian Taxation Office on behalf of the employee or contractor. These payments are based on your expected income level for the year and will be taken into account when assessing your tax at the end of the financial year. The financial year for tax purposes starts from the 1st of July until the 30th of June of the following year. Taking the gross pay of $1,100 from our payslip example, your employer's payroll software will take your salary and assume an approximate annual taxable income. The payroll software will then find an estimate for the tax payable and apply a pay-as-you-go tax deduction to be withheld. These tax installments ensure that after you lodge your income tax return in the following financial year, the tax owing has been prepaid by your weekly PAYG deductions on your payslip. The PAYG withholding will include an estimate for your income tax, Medicare levy, and other nominated optional deductions such as a help debt repayment. It is best practice when you fill out your tax file number declaration to do so correctly when you start a new job to ensure you don't end up with a tax liability when you lodge your income tax return. We'll go through those steps now. On the fourth page of your tax file number declaration, you'll be asked to fill out the Payee Section. Under question 9 and 10, you'll be asked whether you wish to claim the tax-free threshold and whether you have a government loan such as a help debt. No tax is applied to the first 18 grand of income earned at the start of each financial year. This is known as the tax-free threshold. For example, if you select yes at question 9, the tax-free threshold will be applied and there will be no PAYG deduction as you have not earned above $18,000. However, if you select no at question 9, then there will be a PAYG deduction applied and collected by your employer for your income tax. It should be noted that if you overpay towards your PAYG deduction, then after you lodge your income tax return, you will receive a tax refund on the amount overpaid. However, if you underpay, then you can incur a tax debt or liability that, if left unpaid, can incur penalties such as interest. If you go to university, you will often fund your studies by taking out a higher education loan or help debt. Once you leave uni and begin working, you will be required to start paying back the loan. At question 10, you must tick yes to ensure that your PAYG deduction includes an amount to cover your help debt repayment. Now, repaying your debt is compulsory and will be applied to your income tax return. Here is the 2022 financial year's repayment income thresholds and rates. The repayment percentage incrementally creeps up the higher the amount that you earn. Let's take the example of a taxable income of $61,000. The repayment rate applied is 3%. The 3% is not off the balance owing, but is applied against the $61,000 taxable income. Therefore, the 3% repayment rate will be applied and the repayment owed is $1,830. And that should just about do us for this video. I hope that you found the information possibly useful. Thank you for watching Australian Financial Literacy, and I look forward to the next video with you guys.